Hi, this is Jonathan with the Strategic Multifamily Investing Podcast, and I have with me a special guest. It is Bruce Wuollet, and he's a seasoned operator. And as we've been doing for the last couple of episodes, we've been talking to seasoned operators to understand how they got into multifamily investing, what makes them unique, and some lessons learned that they have right now. So, Bruce, I'll let you introduce yourself and tell us how you got involved in multifamily investing.
Yeah, Bruce Wuollet with Bakerson. I like to tell people I'm an SOB because I grew up in the bakery business, so I'm a son of a baker.
Okay, and hold on.
And
You grew up in the bakery business. Who was your dad, your mom, a baker?
my grandfather started a bakery in Minnesota in the 40s, and then my father took it over in the 70s, and I worked there from 11 years old. Worked alongside my dad until I was 26. So that was 15 years I worked at the bakery.
So are you still baking now or no?
I do it as a hobby, but I'm not real. I'm not active in it in the bakery business. But yeah, I still do it in a hobby. My wife and I have done a couple of thousand cupcakes a year on average, and I've done dozens of wedding cakes in the last 10 years. So I do it. It's something that I still have a knack for, I guess.
There you go, man. Listen, you grew up with you've what, third generation baker. That's awesome, man.
Yeah, it's been really fun.
So you said you did it all the way up until 26, and then what did you do?
Well, then I got into executive recruiting or headhunting. Did that 2 years in Minneapolis and then 2 years in Chicago. And it was very good income, very lucrative, but it wasn't that fun. I didn't enjoy the grueling work. And then there was, as soon as if you take time off, you're on, it was 100% commission. And like I said, it's good income, but it was grueling. So I said, I'm going to try something different. Tried medical sales in Scottsdale, Arizona for a year. And that was a pretty significant pay cut, and it was a good experience, but it wasn't what I wanted to do. Working with product, I like service better. So then I started a drug education business, did that for a year, and then closed that down with a break even. And I had read Rich Dad, Poor Dad, and I thought, well, that's pretty interesting real estate. And my friend Gary was doing tax lien foreclosures, and this would have been 2001.
Okay.
And doing tax lien foreclosures in Arizona, and we were getting properties for pennies on the dollar. Sometimes $2,000, $3,000, $4,000. We'd get into the property, and they're pretty rough. They're probably worth 25, 30 at the time.
Got it.
And then I mentioned to Gary after reading Rich Dad Poor Dad that you're leaving a lot of money on the table with these things, and we're walking away from these deals because the people redeem their taxes, and they still may want to sell. And he said, I'm not spending $10,000, $20,000 for those. So then I said, well, what if I do? So then I started buying properties from him. Picked up 3 houses, a triplex and a duplex. And I said, well, this is fun. I want to do this full time on my own. And so I left Gary and ended up working with Jack Martin, whose dad worked for my grandfather in Minneapolis alongside my dad. And he grew up in Seattle. They moved from Minneapolis to Seattle. And we all, the two of us ended up in Phoenix, and he was a general contractor. And I said, hey, we got to talking. And that's where the name Bakerson comes from. We're both of our fathers were bakers. So we're just paying homage to them. And then as we got into the single family, we flipped over 2,000 homes and 2,000 transactions, and it really went well. But then there was a tapering off. So we got into multifamily, flipping wholesaling multifamily. We did like 25, 26, 27 multifamily units, small to big. And we had a guy call up and says, hey, you guys want to be partners with us on a 64 unit and 120 unit. And so we did. We formed a 3-way partnership, watched through that process, and I said, man, there's some ways we could do this on our own in a different way with syndications and other types of methods. And so we bought 4 more properties in Phoenix, a 6-unit, an 8-unit, a 16, and a 22. And we said, this is pretty fun. Well, then the market got where we thought, hey, it's almost peaked. Margins are too small. So we looked into Tucson. And we started, we've done 11 projects in Tucson, and we have 3 left down there, and then we're looking to buy some more. But along the way, I realized back to Phoenix, so I said, it's probably almost peaked. The margins are slim. Some of those properties have doubled since then, so don't use me as an economist or a prognosticator on where the market's going, because I really don't know. But our margins, it just didn't work with our business model to stay in the Phoenix market. But now we've been looking at some deals. We're making offers again in Phoenix. We're seeing some opportunities start to trickle in. So I think we're going to see some purchases in Phoenix in the coming year.
That's good. That's good.
So that's a real fast. I mean, it's
Yeah.
quick. I went through the details, but hopefully you picked up something there that
Yeah,
the
there are a
trail.
couple of different things there. A lot of people who start in the multifamily generally come from the, single family home, business where they're doing flippings or they're doing wholesales. Now, were you both doing wholesaling as well as flipping, meaning fixing up the property and selling, or were you just primarily just buying, fixing, and then selling?
No, we were in between. I called it wholetailing because we would buy the property, we'd take it down, we'd buy it at the auction or REO, and we'd actually own it. And we would get rid of graffiti, board up the windows, make it city compliant so that all the notices are, there's no violations. And then we'd sell it to investors or homeowners. And towards the end, it was primarily homeowners they wanted to fix up and get into their homes. So we were able to find a niche where we could get homeowners into these homes with private money. And then a couple of years ago, I ran a whole bunch of numbers to see how many people still own their property. And it was around 70% of the people we sold to still owned it,
Wow.
nearly 10 years later or 6 years later. So it's pretty exciting to see them because that's where we're really focused on the homeowner as opposed to the investor. Now we sold a lot to investors too over the years, but
Yeah.
we really like to take care of the homeowners and get them. But then Dodd-Frank shut that down because we couldn't do. What we do is we'd create seller carrybacks and then sell the note to investors on the open market. It was an unregulated industry, and there was nothing wrong. We didn't get any fees for the note. We just created the note and sold it at face value, and we made money on the house. We made sure we were very specific that we weren't brokers, we weren't lenders, we were merely property owners. But that got shut down with the Dodd-Frank bill. Said you can only do up to 6 seller carrybacks. So we worked with a broker, lender, and then she charged fees, and the cost of purchase actually went up for our buyers, which was unfortunate that Dodd-Frank did not have the foresight to see that houses with mortgages under 50,000 are really going to be hard to fund because banks at that point were all 50,000 minimum, and our houses were selling for 50, and they bring in 10%. It was unfortunate, but now that of course those properties have tripled since then. That was in 2000.
I would assume so. So question, with all of the wholesaling and flipping, because you went on to do some things, from a multifamily perspective, which I'll get to in a second. Do you think it's best for an investor to start in single family, or can they go over into multifamily? Because I think the first couple of ones that you actually received was a duplex and a triplex. I mean, should someone go right into multifamily, or should they start with single family homes?
I'm not one to give advice, but I certainly have my opinion that the way I did it is probably not the best way, in the sense that there was a lot of growth. The growth curve continues. Like every 2.5, 3 years, we have to have another growth because the way we did it, that would dry up. So we're always projecting where we can go. But I believe if somebody could get right into multifamily with the right team, there's nothing wrong with going straight to multifamily. But I would recommend. Again, it's an opinion, not advice, because advice comes with too much responsibility. But
Got it.
but that they'd form a team of somebody that has experience, because the lenders are going to want that. They're going to want that experience. But I know a lot of people have gone from single family to multifamily. Mm-hmm. However, it is a different deal, because you go to the bank for single family up to a 4-plex. You can go to a bank and get a regular homeowner style mortgage. Yep. Whereas you get into 5 units and up, and it's commercial. So it's actually a whole different baby. So if you start a single family or not, I don't think one or the other is the advantage. Knowing how to run numbers and knowing how to project where it's going. When I first got introduced to multifamily, I was like, this is mind blowing. How could anybody do this? Got it. And then after our first deal walking through, I said, okay, it's not as difficult as I thought. 120 units is basically 120 houses on one parcel. You just look at it that way. Okay, I can do that. I can break it down that way.
One roof, not 120 roofs.
Well, I don't know. The 120 unit we had was 34 fourplexes on 10 acres. So it was quite a deal. But yeah, so that I wouldn't, if someone get right into multifamily, if that's where they want to go, I'd jump right into it. Just make sure you have the right team, and you have somebody on staff or somebody on your team that has the experience to get the best financing you can.
Got it. Now, you mentioned that there was some wholesaling of multifamily, and how many units were you guys wholesaling? You were wholesaling multifamily, and what is wholesaling multifamily? There may be a niche for somebody out there.
Well, we'd buy the property, get it in escrow, and we would flip the contract. And I think we did, like I said, it's 26 or 27 different multifamily properties. And
How many
one
units
was,
on
yeah,
average?
one was 40, 50 units. There's a 250 space mobile home park. There was a motel. I don't remember how many units that was. A motel in Tempe that we flipped. That was, they wanted to turn into apartments. But I'm guessing they were mostly in the 25 to 40 range. I'm searching my recollection. It's been a while ago, so that was back in 2012. But yeah, the largest one was a 250 space mobile home park.
Wow. Okay. And you mentioned that, the margins in Phoenix at one time were not exactly what you wanted to move down to Tucson. And you were kind of, doing a lot of in and outs. And so, did you hold on to a lot of properties? It sounded like you sold a lot more than what you held on to.
Yeah, we actually didn't. All of them were on the 18 to 36 month plan. So
Okay.
we would get in, reposition, sell, and do the next project. So we went from the wholesaling, which our average hold on a house was 52 days. Our average hold on an apartment building is closer to 25, 26 months.
Wow.
So it's a similar process. But now there's one property we picked up in Tucson that's going to be a legacy. We're going to hold that one indefinitely. No sale date really in mind yet. So we're getting into what I would call legacy ownership. And I'd like to buy all of our properties without the intent to sell. The selling process to me is not near as exciting as the buy. The buy is really fun. That's where we really make the money. You make good decisions. On the sale, we dig our heels in. This is what we're willing to do. And there's always people wanting a retrade, a credit, or something on the back end. And it's just, we don't give in on that, but it just gets annoying and tiresome. And it's a mind suck, as I call it, that it just takes up a lot of energy. And I thought, what if we never sell? And if we do sell, it's to a performing operator that knows what he's getting and it's not going to, because we're selling performing assets. And so at this point, I think we're going to hold them. Anything we look at, how can we hold it indefinitely?
So when you're holding it indefinitely, you're getting a 5-year, 10-year mortgage, amortized over 30, and then are you going to refinance out or just keep refinancing, if you will, moving forward?
Well, the one that we're looking at now is we're going to get a agency debt on it here this year, but we'll replace that. Our goal is to replace that with HUD financing. The challenge with HUD financing, it takes anywhere from 9 months to a year to get your first deal through HUD, but that has a 40-year amortization and a 40-year, and there's no call, so you can hold it all the way 40 years, and you can recast the loan. If you want to take some capital out, you can prove that the value has gone up. You can recast the loan with HUD and process it and get some more capital out. So we're going to move that direction with our financing, so that and hopefully by then we've got all the investor capital or a lot of it out. Once we go into HUD or the recasting of that loan, we get all their money out, so that the investors can stay in the game with zero money left in the deal.
No principal. They can move that principal potentially on to another property with you guys.
Well, that would be the hope. But if they have some other investment they want to do, they're still compounding their return, whether they invest in something else or with us. The same dollar is working twice as hard, and that's really where we want to go with our investors.
So then, with the HUD financing, and again, I'm ignorant in this area, versus the agency debt. Generally, agency debt, you're getting, a Fannie or Freddie loan, you're holding on to it. You get a 5-year, balloon at the end of 5 years, or you refinance, or you hold on to it for 10 years, and at the end. But with HUD, you're saying it's a 40-year loan. I think is that where some of the affordable housing type financing it comes into play, or there are some covenants as to rents and things of that sort for having it that long. What are some of the drawbacks?
No, the HUD financing has no limitations such as that. The drawback is it takes, once you get in their system, you do your second and third loan, it's still a 6-month process for when you start it till they fund it. They don't fund it in 90 days or 60 days or 45 days. That's just not happening. With agency debt, so you don't use HUD for a purchase, because there's not a seller that's going to say, you know what, yeah, take a year to buy this property. That's fine. I don't know any sellers that would do that.
Yeah,
so it's not used for purchase. It's used for hold.
Yeah,
and it's more heavily on the asset-based lending than the operator-based. So it's they want a lot of details and they want to see the track record continue. Sending them T12s is a good start, but they're going to want, they get weekly or monthly reports. They're going to ask you throughout the process, okay, we need updated financial, we need updated rent roll, and then they analyze and they ask you a question that, okay, now I've seen this shift here. What happened there, and what are you going to do about it? How are you going to make it? So they come in more as a partner mentality than a lender mentality, and that's why they're willing to hold it for so long.
Got it. Okay. That's different. I've never heard of that approach in terms of legacy. I've heard people say, well, we're going to keep it forever, but my assumption was always that we're going to, refinance at some point in time. But that makes a heck of a lot of sense.
Well, it's a safer investment. The biggest plus to that loan is like if you have a 5-year call, we might be in the middle of a valley in our market cycles because we're going to have cycles. There's always going to be cycles. Our fiat currency requires us to have cycles for it to stay alive. That's a whole other topic. We could talk about how money works, but with HUD, you don't have that 5-year call. So let's say 5 years, if you have a 10-year note, that's safer because maybe in year 7, you might say, you know what, I see some things on the horizon. Let's redo this loan. Let's get a supplemental. Let's extend this to another 10 years out. And you can do that with agency, where with HUD, you don't have to worry about that. You can recast, but if the market's soft, you wait. But they're not going to call your note. And that's what's really exciting for this. For the investors that are in the deal with us, they know there's not this sunset in 5 years or 7 years or 10 years that they have to be worried about. They know the loan's going to be there indefinitely or for the life of the project.
And right now, to get into something that's agency, given the rates where they are right now, that's a good thing. Maybe in the future when rates rebound and go back up, having a HUD loan, may not necessarily be as profitable because, again, the rates will be a lot higher. And as we have cycles, if you're in it for 40 years, you may hit that cycle where, you get a dip in rate, but you're at 8%, let's just say. I'm just throwing out a number. Or right now, I think we're in about the 3s and the 4% in terms of what people are getting on mortgages right now. For 30-year amortization. This is the agency 30-year amortization, holding on to it for 5 or 10 years. And a couple months ago, I'm not sure if they're still doing it now. I think it is, but it's a little bit more limited. People were getting interest only for the first 2 or 3 years. It allow you to be able to get, take some of that cash flow and be able to do CapEx and return, investment back to your investors. But I want to shift.
Yeah, and you can get 5-year IO as well, up to 5 years interest only. So, okay. So shifting gears, I interrupted you.
That's pretty good. I've got to go do some more research on that. One of the things that you mentioned is, hey, you don't have to start out in single family. If you were interested, and again, it's more or less not advice, but an opinion. If you partnered yourself with a group that had experience, because a banker is going to want to see that if you're going to go through a deal, and you really could get involved in multifamily just starting out. So that's a good idea. But I guess I want to pivot now a little bit more to, how you all run your business. I mean, what I thought I heard, in our first preliminary conversation is your approach to how you deal with tenants. You mentioned in this conversation that you spent a lot more time working with people who were buying their home long-term, and 70% of the people kept it. What, makes the way that you all operate your business, unique?
Well, when we were selling houses to homeowners, we walked them through the process. We walked them through title. Many of them didn't understand the process. And so we weren't realtors. We were just selling the house direct to owners. And they really liked how we treated them. And if there was questions, we didn't make them look bad. We just said, hey, we'll walk you through the process. And I found out that working with the ultimate homeowner was real rewarding. And then when we got into the multifamily, I realized, or before that, so I noticed a lot of investors would treat their buyers really, really poor. And I thought, you're making some good money, at least show some respect to your buyers. They are actually your customer. So when I got into multifamily, I said, who is your customer? And people say, oh, it's your investor. And investor is your partner. And you want to take care of them. You want to pay them. And then, but who brings the money in? Without residents, you have no income. Just like if you have a store, without customers, without people coming in to buy something from you, you have no income. You can have the best investors behind your store in the world, but if you have no goods going out the door, you're not making any money. So what we offer is a place to live. And our customer, in my mind, is the resident. And if you just look at it, like in Tucson, for let's say a 1-bedroom apartment, you're renting it for $700 a month for 5 years. It's $42,000 a year, or $42,000 in 5 years. They're a $42,000 customer. And I thought, if we can keep somebody for 5 years, that's pretty good. Well, if it's a $1,400 resident in a nicer neighborhood, that's an $84,000 customer. And I was just shocked at how many landlords, how many property owners really don't care about the resident. They don't treat them with dignity or respect, and they feel like they can push them around and because they're the owner. Well, to me, it doesn't matter what socioeconomic scale you're at. Everybody's human. Treat them with dignity, and
right.
And that's where the dignity hasn't been in C class, and we feel we bring that in. And the residents do enjoy what we've done. And we've got many instances where they've thanked us for how we've changed communities and made it safer and cleaner for them. So that is our focus.
So talk to us about some of those systems and those things that you do in order to, display dignity without just saying dignity, but you're turning those things around. What do you all do in terms of your systems or how you approach things?
Well, listen, the biggest thing you can do is listen to the residents. What do they want? And it was one of the first buildings we bought was a 64 unit, and there was an elderly lady struggling to go up the stairs with her bag. And I grabbed it and ran up the stairs and asked her if she lived there. And she said that she did. And I asked, do you like it here? She said, yeah, but I'd like to be on first floor. I'm a widow. She was elderly. And I said, so then I talked to the property manager and said, hey, can you get her onto the first floor? And he said, sure, we can do that. We just purchased the property. Well, then I was at the property later, and I heard somebody hollering, kind of hollering for me, but she didn't know my name. But she says, hello, sir. And I looked, and it was this woman. She says, thank you so much. So I went from a 1-bedroom into a studio. My rent went down, but I got a brand new unit, and it's on the ground floor. Thank you. And I said, that's really what we want to pass on to our property managers, that if there's somebody that doesn't want to take the stairs, put them on first floor. We got plenty of first floor units. And then another one is, when we're cleaning up the properties, we pick sometimes some really bright and vibrant colors, grays and orange, bright orange. And people say, why do you do that? I said, just to show that there's a new person here, a new owner, and somebody that when you're willing to do that, it draws attention. You better take care of it. If you draw attention to that property and we have weeds that are three feet high and unkempt shrubbery, that's bad. So it forces you to say, hey, if we're going to do this, people are going to look. If they're going to look, it better look nice. And when I was there, one of the guys said that he didn't like the color, but then a little bit later he says, hey, hollers at me across the courtyard. And so I'm walking over to him, and he's another, tall guy. And he said, I'm sorry what I said about this property before, that you guys have done a great job. I love it. Thank you so much. He says, the crime activity has gone down and I feel really safe here. And I said, that was really cool. That was good to hear that. And there's story after story of that. So you listen to what they want. But the biggest thing is our mission is creating communities which are safe, functional, durable, and clean. And okay. Pueblo Springs, we purchased, and the police department in the area said, why would you ever buy this property? It's high crime. Just a few short months later, they talked to us directly, but talked to the property management company and said, man, whatever you guys are doing, the 911 calls have just plummeted. The activity here has gone down. The drug use has plummeted. That we really like what you're doing. We raised the bar for our residents as well as ourselves, that we're not going to put up with this type of activity. And sometimes when we go in there, I'm tall and Ben's tall, and we go walking in, and when we'll carry, we'll be carrying on our hip, and people see that and they pause. But that's how when we first go in, sometimes you have to do that. But we don't always do that. Most times we go in without anything. But
so are you putting in the what I call the blue light specials, cameras and LED lights and things of that sort to reduce the crime, or what are things that you're doing to say reduce crime in some of those units or those apartments?
Well, some of the simplest things are things that are advised by crime-free multi-housing of Arizona, and the first thing is it's either it's hip low or shoulder high. So the bushes should be should be cut no taller than your hips, and the trees should be cut no lower or no lower than your shoulder. So there's less places to hide, right?
Got it. So you said that organization was Crime-Free Multifamily of Arizona?
Multi-housing. Multi-housing. Yep.
Got it.
And it's a program that I've been through 3 times, twice in Phoenix and once in Tucson. We are crime-free certified. Our property managers, we ask them to go through it. They're third party. But that's one thing. The other thing is a lot of what they call them shake and breaks. They're those lollipop style lights that people have. They have the pedestal with the bulb. They call those shake and breaks because people just go up and shake them and the lights go out and then they do their drugs or whatever else. We got rid of those and we put LEDs. We put them up high and we put them in spots that they're difficult to break. The old security bulbs, they would just shoot them with a BB gun or throw a rock at them and make these dark corners. Well, LEDs are very, very durable from that, and they can withstand some of that. So we've done that as well. Fencing off the area, limiting entry and exit points is another thing you do. So there's less walk-through traffic. They got to stay on the road, less likely to be a problem. And then loitering. If you see people loitering, I come up and ask, hey, do you live here? And they say, well, no, but my friend does. I say, okay, where's your friend? Oh, he's not home. Okay, why don't you come back when he's home? And they leave.
Right.
So just things like that you need to really do on a regular basis.
Got it. My apologies. My phone is going off here. Thought it was on mute. So there was another question that I had. You mentioned your property managers, and I was going to wonder, are you managing any of your properties at all, or are you just, outsourcing the management of that?
No, we do all third-party property managers, and the reason being is we did set up for a short time our own property management company, and when we did that, we found out that it was just there's enough good property managers that you can work with, right, and they already have systems in place, and so we ended up working with two different property management companies we use in Tucson, and there's two other ones we've used in Phoenix. So yeah, we do work closely with them. And what we did differently, what I recommended to individuals, mm-hmm, some have quarterly reports, some have monthly reports. We get weekly reports from our property managers. And at first there's low resistance, but then we get it. What we want is, what's the occupancy? What is the pre-leased? What is the income? What are the expenses week after week after week? And Nate, who manages that for Bakerson, he can go through those really fast and deliver them to our Monday morning meeting every Monday. Here's the update. Here's how many units are occupied. Here's how many are pre-leased. Here's what our expenses were, and here's what our income is for those properties. And he can go through that pretty quick. But so weekly reports are advised because you keep a better eye on trends.
So then, question: do you have some sort of a system that you're using, say Yardi or whatever, in order to get those reports from all four of your property management companies, or are you just getting those via PDFs, or how do you kind of, I would assume with, a couple hundred properties or units that you're managing, that you, in four different property management companies possibly, that you're, everybody's on a different system or something.
Yeah, the reports, the Yardi Matrix we like the best, and AppFolio is another one that people use. Typically those two. That's where we get our monthly and quarterly reports, and Greg gets those. He's our asset manager. And then, but the weekly reports are done through email. Just here's an updated email. Here's what we have. And we can verify that. We can dial in, like AppFolio, we could sign in ourselves and generate those reports. But we also like to talk to them. What have you pre-leased? What's the activity? How many people have walked through the units? And at first it sounds like it's overwhelming, but if you do, I have a saying that I've adopted in our company, just a little bit every day. So if you do a little bit on property management every day, all of a sudden the week goes by and you say, boy, I got a lot done. Or if you put it all off till Friday, it feels like you haven't got much done. And the example I like to use is if you're into exercising and you say, I'm going to exercise a half hour a day, and you say, I'm so busy, I'm just going to do 5 hours on Sunday. It's not the same. You're not going to have the same results. You do a little bit every day, you're better off in the long term. So that's how I'm working with our property managers and our staff.
That's excellent. That's excellent. I know that some property management teams that I've talked to before, what you're asking and, what you've asked, what you're doing and implementing, they would say is probably a little bit overwhelming. And they probably would not want to work with someone who was putting that out there. But it seems like you've already, in your conversations with these property managers, have let them know this is what your expectation is. And obviously this is giving you some good results because, you've done a lot. So right now, how many units do you guys have under management, and where would you like to be?
Well, we're in the selling mode because of the market and the shift in our strategy. So a year ago we had over nearly 500, and we have 90, 70, 165 plus. about 175. So it's shrunk way down. We have a 75 unit that's in escrow to sell. And then the condo complex that we used to have 39 units. I think we're down to 9. Those are almost gone. So the 90 unit we're keeping, but we're looking at a 220 unit, a 45 unit, a 65 unit. So we're looking at multiple properties right now that to build that back up. But it just goes ebbs and wanes. So like I said, a year ago we were at 444 units plus condos, 39 condos, and now we're selling. Well, it's been a good time to sell and recapture some of the capital. But now going forward, it'll be legacy, and our goal is in the next few years to get to 1,500 units under management. Wow. And with my hope is to be at no more than 65% leveraged loan to value. Wow. We keep it lower than that if we can for safety, because the market's going to go soft, and I want to make sure that we're protected, our investors are protected, and the community is still running with a shifting market. So I want to be very cautious going into the next 2 to 3 years, because I believe we will see a dip.
So how can someone reach out and talk with you a little bit more about maybe investing from a legacy perspective, and or is there anything else that you need that the community may be able to provide?
Well, our biggest strength is finding the assets, underwriting the assets, and really putting them into play. And once we own them, we're very efficient at making that change. Our biggest gap, I don't call it a weakness, I call it a gap, is is capital, is getting enough capital in fast enough, and then the managing of the investors from there. And we've implemented some new things that are making some great progress. But if there's people that say, hey, I'd like to partner, I like what you guys are talking about, by all means call me, or even if you have a question on what I meant by anything that we've shared, I'm willing. I'm an open book on that. We live in the information age. Let's share as much information and as little disinformation as we can regarding multifamily. There you go. And so you can go to our website, bakerson.com, bakerson.com, email bruce@bakerson.com, or you could call or text me on my cell, 520-808-9111. And I share that with the expectation that somebody will call. So please, if you have any questions or text, please do.
Well, one of the things that I found in talking with operators like yourself who've been in the business for a while and are so open, they really are open to having a conversation. And Bruce, I want to say thank you to you and your team. We've had several conversations over this past month or so, and you've been willing to share, and we've had some great dialogue, and we hope to work with you and partner with you moving forward. And anybody that's out there, again, what you see is what you get. He is definitely the authentic one to want to work with you. So please feel free to reach out to Bruce. Bruce, again, thank you for your time, and I know we'll be talking very soon. All right.
Thank you so much. And hopefully there's a golden nugget that somebody could pick up and do something with. So thank you.
I'm sure there's tons. Take care.
All right. We'll see ya.